Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we're starting off this week on a slightly better tone than we had last week, which saw investors show a fair amount of concern around just the valuations that equities have traded are currently trading at, and also just the sheer rally that we've seen here since early May that has gone unchecked without any real form of a pullback or a consolidation period. We've just seen this continued grind higher here on the back of expectations of lower interest rates into the second half or the Q4 of 2025. We did see some economic data come out on the positive side last week with GDP and inflation data. And that was confirmed further this particular week with more inflation data that is showing that inflation is largely coming in as expected rather than continuing to surprise the upside, which makes the Federal Reserve's calculus of how much and when to cut rates a little easier to navigate because the Fed was kind of stuck um, between rising inflation and a slowing labor market. At the moment, the primary concern now is shifting far more to just the labor market. We're meant to have a reading this particular week on employment data on Friday with the non-farm payroll and unemployment data. But we are heading into a potential government shutdown, which would mean that if the government is shut down, we would not get that um, jobs data on Friday. So that is one thing that is arguably the most important economic number that's going to influence the sentiment of equities that is currently at risk with regards to the government shutdown. Um, we have seen positioning within the equity markets get a little bit more defensive. Last week, we saw energy, utilities, and real estate were the sectors that led the market, while consumer staples and materials were really lagging behind. Um, Interesting to note that commodities at the moment remains a bright spot, especially gold. We've seen gold, a significant amount of demand for safe havens heading into uh, the slowing economy that we currently find ourselves in, as well as the potential of the government shutdown tomorrow, is something that has continued to drive interest in safe haven assets such as gold. So commodities remains one of the best performing assets at the moment. And probably what's most interesting to me is the fact that as equities continue to climb, yields have actually climbed as well in the last couple of weeks after the Fed has chosen to cut rates by 25 basis points. We've seen the 10-year yield rise by nearly 25 basis points in the last roughly week and a half since the Federal Reserve cut interest rates. And this is something that I think we need to be paying attention to right now because there's still the concern that $36 trillion of debt is clearly unsustainable. If yields continue to remain relatively elevated, that becomes even more unsustainable. And we need to have a strong combination of monetary and fiscal policy to bring things back in line. And at the moment, the markets are not particularly cooperating with that. So um, the debt market is one that we really need to be paying attention to, not only on the treasury side, but also on the corporate side as well. So we'll take a look at a few charts here um, to help you understand what we're referring to. So if we look at the S&P 500, we've been on this uptrend. It's a fairly steep uptrend that has seen very small pullbacks here that have become kind of buying opportunities. And we saw one as of Friday last week. Basically, we got a bit of a pullback here. We bounced off of that support level here, and yesterday we followed through with that. The expectation is still at the moment for the S&P 500 to continue to get back to all-time highs and potentially make a new record high again. But this rally is getting quite long here. It is one of the steepest rallies we've seen that have gone unchecked. So the further we go, the higher the risk of a pullback or some type of consolidation period. So that is one thing that we are paying attention to here right now. And we're seeing that across the board for all of the major equity indices, whether you're looking at the S&P 500 or if you're looking at the NASDAQ 100, very similar price action here. Basically, pullback here to the trend line provides the buying opportunity that a lot of retail investors are continuing to use these opportunities as buying opportunities. Small cap has also shown the similar type of performance here. Small caps actually outperforming the S&P 500 in this period of time, but same thing, small shallow pullbacks to the trend line have provided buying opportunities, and that's exactly what where we find ourselves in at the moment. Even if you look at equal weight S&P 500, the RSP ETF, we have the similar type price action, though, as you can see, the equal weight hasn't really moved much higher here over the last couple of months here. And that really shows us that participation on this rally is starting to get more narrow over the last month or so. And that really shows us that it's a fewer and fewer stocks, mostly the mega cap names that are dragging the markets higher, and that participation from the rest of the few hundred stocks that are in the index are not really showing meaningful gains. And that's not a particularly good sign. Now, here's the thing, is that could resolve itself in two different ways. Either the market cap index, meaning the traditional S&P 500 index, could pull back and sort of resolve that divergence between the participation rate and the rally that we've seen here, or the rest of the market can play catch up. So it's not necessarily a bearish signal when we see this, because there are, like I said, two different ways that it can be resolved. So looking at kind of the markets here, the big thing that I do think it's worth paying attention to is the fact that if you look at high yield bonds have been on a pretty significant tear here, just like equities. As you can see, HYG was a $75 ETF. It's now an $81 ETF. Obviously not as steep in terms of performance relative to the S&P 500, but from a performance perspective, very similar performance. And, we typically use high yield bonds as a proxy for, whether the markets are in a risk on or risk off environment. When high yield corporate bonds continue to rally, we see that as a environment where investors are willing to take on risk and take on risk assets like equities. However, one of the things that we have noted is that we've seen this substantial rally here in high yield corporate bonds, which are typically junk bonds or companies with lower credit quality. What we've started to see here is that the spread between what lower quality companies are paying in terms of interest rates relative to risk-free treasuries are continuing to get compressed. Meaning, if you're investing in lower quality credit, you're not really getting a lot more yield for it compared to buying, let's say, a treasury bond, which in theory has no risk because it's backed by the U.S. government. And that feature, when the spread between riskier bonds and risk-free bonds get tighter, those are signs that the market is frothy, that there's excess, that there's too much money chasing, risk assets like these riskier bonds compared to risk-free assets such as treasuries. So we've seen this in the past. We've seen this in 2008 before the financial crisis. So it's something that is important to be aware of. It doesn't mean that we're headed for a recession. It doesn't mean necessarily that we're set for a major drawdown here in the equity markets. But it is important to understand that these things have were in place prior to the 2008 financial crisis. So those are some of the things that I think are worth paying attention to here at the moment. So looking at ideas here for today, first one I want to take a look at here is OLED. So they produce a lot of the displays for phones. OLED, as you can see, this is a stock that has been sort of range bound for quite some time. It is forming a bit of a base here, and we're starting to see a breakout here from that base. The stock is down about 3% here yesterday, but it's still just trading above around that 145 breakout level here. And we're looking for is a potential continuation higher here from where it's trading. Now, OLED trades at around 25 times forward earnings, which is a pretty significant discount to its industry. I'm sorry, it is a premium to the industry. It's trading at 25 times versus 20 times for the industry, but it's expected to grow significantly faster than the industry. And what's more important is that it's far more profitable than the average stock in its industry. Its net margins are north of 36% versus the industry is currently close to around 7%. So for those reasons, OLED is one stock that I quite like in this market environment because they are far more profitable than its peers, and I think that's really important to be aware of. Give me 1 second. I'll be right back. Sorry. Oh, sorry. I just realized that I was on mute for the last couple of minutes. So just to reiterate, the next stock I want to take a look at here is Fortinet. And Fortinet, the reason I want to bring up Fortinet and take a couple of minutes to discuss it is because Fortinet, even though we have a bullish view on it, it has generated this bearish trend following signal. And what that and I know that that can be confusing is, why are we bearish? Why are we bullish on a stock that has generated a bearish signal? Well, the bearish signal is generated whenever a stock is in a bearish trend, which you could argue that because of this gap lower, the stock is trending lower here. But whenever a stock is trending lower, if it rallies enough, it becomes an opportunity to take a new bearish position in this particular stock. However, if a stock is recovering from, let's say, a bearish state, right? Meaning when the stock goes from bearish to bullish, it at some point has to trigger that bearish trend following signal before it can work its way higher and continue to move higher here. So essentially what we're saying is that onto the path of a stock that has switched from bearish to bullish, it has to generate a bearish trend following signal. And I admit that that can be confusing. But this is really where if you only rely on technical analysis and you're only relying on signals from technical analysis to derive your ideas, there's no way of differentiating between whether a stock has generated a valid bearish trend following signal like Fortinet has from the stocks that are likely going to recover and potentially start moving higher from here. And that's why I think it's really important to look at fundamentals. It's really important to understand, what does a company do? Why is it meant to recover? Because that's how you can build conviction as to whether you agree with, okay, this is a bearish stock, it's going to continue moving lower, or no, this stock is clearly starting to recover. They're seeing optimistic signs. There are signs that this is likely going to start moving higher from here. If you're just looking at charts, if you're just looking at technical analysis, there's just no way to tell the difference between those two signals. But when you look at fundamentals, that gives you a different layer of information that you can then discern whether or not this is a stock that you want to take a bearish versus a bullish view. Now, Fortinet, they're in the cybersecurity space, one of the largest cybersecurity stocks out there. And recently, they have focused a lot of their attention on AI, specifically how to use AI to fight cybersecurity threats. We're all familiar with, or many of us are likely familiar with CrowdStrike, which is probably best known for their cloud-based AI cybersecurity software. That's a stock that's trading at over 130 times forward earnings. It's trading at 25 times sales. From my perspective, that is way, way too expensive. Fortinet is far more reasonable in terms of valuations, trading at 30 times forward earnings. It's a very profitable stock. It has net margins north of 30%. CrowdStrike is actually not that profitable. Fortinet is extremely profitable, and growth rates, we're talking about 10 to 12%, EPS and revenue growth rate. So a healthy growth rate, strong margins, trading at a valuation that's just a slight premium relative to the industry. So for those reasons, I quite like Fortinet. They seem to be executing well on their AI initiatives. And for those reasons, I think this is likely the type of stock that is going to recover rather than basically use this rally as an opportunity to be a seller. So, what I want to do with these sessions is to not just present ideas, but help you understand the process by which we come up with these ideas, because that process is going to be more valuable to you as a investor, as a trader, than just the ideas. Because ideas are cheap, ideas are a dime a dozen, they come and they go. But if I can help you build a process that you can rely on, that you can um, start having more confidence in your ability to sort through the noise, that's going to be, um, like I said, much more valuable to you and hopefully something that you can take away from these sessions. So the next one I want to look at is Citigroup. And out of the major banks, Citigroup is by far the cheapest from a valuation perspective. It's trading below book value. It's trading at 0.97 times book value, which is well below the industry average, which is around 1.4 times book value. It's expected to grow faster than the industry in terms of earnings. It's expected to grow roughly the same pace in terms of revenue as the industry. And the reason that it trades at a discount is because it's not as profitable as most of the other major banks. It's not nearly as profitable as JP Morgan. It's not as profitable as Morgan Stanley, Goldman Sachs, the banks that it generally competes in. But they've been doing a lot recently with regards to their investment banking division, reinvigorating that particular department. They've actually recently just ranked number 4 in terms of investment banking on the major out of the major banks in terms of the amount of deals that they've done here in the last quarter, which is a spot that they have not held for nearly over a decade. So they clearly are executing well on certain parts of the business that they're trying to invigorate. They've been focused on profitability. They've been focused on getting net margins back into that 25-26%. And they've also provided guidance in terms of expectations on their returns on capital. And that guidance has continued to improve quite a bit here over the last few quarters. So that's why I quite like Citigroup, especially since this stock, as you can see, recently broke out here above, call it 97 or so. It broke out here above that consolidation range, broke out, and now we're expecting a continuation higher here, because if you look at kind of the range that it was in before the breakout here, it was between 88 and 97. This stock had a really nice run here prior to the consolidation period, and now it's broken out here. So I think the upside potential here for Citigroup is quite significant, especially if you look at how low the valuation that it's trading at right now. Next one I want to take a look at here is Elevance Health. So Elevance and United Health are the two biggest insurance companies from a health insurance company perspective. And this is a stock that has taken a pretty significant beating over the last couple of years. As you can see, this is a $550 stock just back in September of 2024. It basically halved in value in about a year's time. And now it's starting to show some signs of potential recovery. Now, I will say, it did have some of those signs of that recovery back here, right? You have this kind of basing formation, broke out here, traded all the way up to 450, and then dropped all the way down to 270. So, this pattern has been repeated before. It wasn't so successful the last time, but it looks a lot more attractive here this time. So we basically broke down below 300, came back to break out above it. It's been consolidating a little bit since the breakout here, and now it's starting to show some early signs of a potential further upside here. Elevance trades at around 10 times forward earnings, which is basically in line with the industry. If you look at growth expectations, EPS growth is a little bit below the industry, but revenue growth is actually a little bit above the industry. So, I usually consider that roughly in line with the industry. Elevance Health is slightly more profitable than the industry. So that's why I quite like this particular stock trading at effectively what is the same valuation as the industry. Because it's more profitable, I do think that the upside potential here is there for this particular stock, especially when growth is essentially in line with the industry. So the charts are telling us the timing might be a good time to start adding some bullish exposure. The fundamentals tell us that we have a relatively compelling valuation. It's not the best valuation that I've seen, but it is definitely one that would justify the stock kind of bottoming and now starting to recover. And the last bullish setup that I want to show you here is Truist Financial, TFC. Truist is a regional bank, but similar to Citigroup, is basically trading at book value, one times book value. And this is a stock that recently broke out here above 45, came back to retest this level of support. Haven't had the best bounce off that level here. Usually we'd like to see a bigger bounce here and just a continuation higher here above 47.5, but we haven't gotten it. But it's managed to hold above 45. So for those reasons, we'll continue at the moment maintaining a bullish view here. Truist Financial is trading below book value, trading below the industry in terms of valuations, but it's expected to grow faster and it's just as profitable as its peers. So because it's more profitable, I'm sorry, because it grows faster, it is just as profitable, but trades at nearly a 30% discount to the industry, represents the upside potential here for Truist Financial. And also with these regional banks, they have commercial real estate exposure. That exposure usually is quite favorable in an interest rate environment that's in an environment where we are expecting lower interest rates over the next 12 months. So for those reasons, Truist Financial is one of the stocks that I quite like here to the bullish side. Next one I'm going to take a look at here is Alphabet. Alphabet, as you can see, has had a really nice tear here recently. The stock gap above 210 all the way into the 250 level here. It's now trading at 23 times forward earnings, which, when we first started talking about Alphabet, which was the pullback here, back here in June, this was trading in the 160s. The stock has had a really nice run since we started mentioning this stock on these Tuesday morning sessions. Yet, when we were looking at this, Alphabet was trading at around 18, 19 times forward earnings. It's now trading at 23 times forward earnings. So you've had a pretty substantial gain in terms of valuations over the last few months. But even with that gain, I think the stock is still undervalued. Growth expectations are essentially in line with the industry, but Alphabet is far more profitable than its peers. Net margins are 31% versus most of its peers in terms of net margins is in the single digits. So the fact that it trades at a valuation that's only 4 or 5% higher than the industry means that there's still, in my opinion, substantial upside potential here for Alphabet. And the other name that I want to bring up here is Meta. Meta has also been on quite a tear, but if you see this stock, this stock was a $740 stock back here in February. It is now a $740 stock in October. So when at the time when it was up here in February, it was a 30 times forward earnings stock. So a fairly expensive stock, and the stock really took a big correction here in April, traded all the way back up here, and in 3 months later, it's still back up 740. But the business has changed a lot in these 9 months. So instead of trading at 30 times forward earnings, it's now only trading at 24 times forward earnings, which in my opinion is very attractive, similar to Alphabet trading at 23 times forward earnings. I think the upside potential here is huge for Meta because they have recently been focusing on how to turn their AI models into revenue. And I think they're in the very early stages of figuring that out. Their ad business continues to be hugely profitable, and they recently just announced a new device, which some people may not have caught this, which is their Meta glasses, which is going to be a commercial version. Obviously, in no way, shape, or form competes with Apple's Vision Pro, but is a commercially viable set of glasses that I think consumers will actually purchase, unlike the Vision Pro, which no real consumers have purchased that. And I think that this is a potential pivotal moment where wearables could be wearables will likely be the next phase of how we interact with our devices. The question is who's going to be a leader in that. And at the moment, it looks like Meta is going to be a leader in that particular space. So for those reasons, I quite like this stock at 24 times forward earnings, especially given the upside potential here. So that covers what I wanted to share with you here today. Hopefully, this gives you an understanding of how we're viewing the markets from a macro perspective, and then how we are evaluating ideas in this type of market environment. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.